Hi, I'm Pattu from FreeFinCal. Today, let's talk about target maturity debt funds. Now, these are actually passive funds, so they're either presented in the form of index funds or ETFs. They are also open-ended funds. Just because they have a target maturity, that means that they will wind up the fund after a set date. That doesn't mean they are closed-ended. Usually, we have closed-ended funds. That is, they open at a set date and then they will mature at a set date. And in between, you cannot redeem the fund with the AMC directly. You can do it via a demat account, but that's near impossible. So this is a mixture of the two ideas. So you have a target date where the fund will wind up, but in between it will be a closed. In between it will be an open-ended fund. That is, you can freely sell to the AMC or buy from the AMC. What? So that's the basic idea. Now, if you look at the average maturity of the portfolio, this is Bharat Bond ETF that I am having. This is the oldest target maturity fund we have. It started in December 2019 sometime. If you look at the average maturity of such a fund, I think this fund is maturing in 2030. You can see that initially it started with average maturity of about 10 plus years, and then it has been gradually falling down. They call this the roll down. They also call it roll down fund because of this. What is the benefit of this? Now, I have said in several videos that when it comes to debt funds, there are two major risks. One is credit risk. This is something that we have now because of all the credit defaults that we have seen: Jindal Steel, Amtakato, Vodafone, Yes Bank, all those credit default events we have seen, and also because of the Franklin winding up episode. Investors are very well aware of what credit risk is and what it can do to the NAV of the debt fund. The NAV will plunge down by 6%, 7%, 10%, or even more, depending on what the event magnitude of the event. So that is the first kind of risk. Now, target maturity fund, what it does is it, to a large extent, it eliminates that risk by saying we will only invest in gilt funds, or we will only invest in PSUs, AAA rated PSUs, or we will only invest in state development loans. So we have two funds from Edelweiss, two or maybe four, I don't remember. I think there are four Bharat bonds, I don't remember, but there are some Bharat bond funds which are like the PSUs, which are all corporate bond PSU bonds in the portfolio. That's one. The credit risk there is not zero but low. Then we have two gilt funds from IDFC. Essentially, as the name suggests, they invest predominantly in gilt and some cash, little bit maybe, but as they will track an index. The NSE has got indices for all these target maturity funds. Then we have PSUs and state developments, 60-40 kind of mix. We have one fund and one fund from ICICI and one fund from Aditya Birla currently in the NFO period. They have different tenures, 5 years, 6 years, whatever, that you have to check it out. So by choosing relatively safe bonds, the credit risk is largely handled well by these target maturity funds. The other risk is something that previously could not be handled well in an open-ended fund. The other risk was called the interest rate risk, or it was called duration risk, or a better name for it is demand supply risk. That is, suddenly what will happen is there will be a mismatch between demand and supply in the market, and the NAV of the fund will suddenly move up or suddenly fall down. But why does this happen? See, we should first understand how the debt mutual fund operates. Suppose I buy a bond, whether it is from RBI or some PSU or wherever. When I buy a bond and receive biannual income, that is twice a year, every 6 months I will receive some income, I will not bother to look at the market value, because this is like just like real estate. As long as I keep getting rent, I will not bother to look at the market value of my house. I may dream about it, but I don't know. I won't seriously look into it. Similarly, in a bond also you won't care. It will mature and you are done with it. But in a debt fund, what happens is, even if the fund manager buys the fund and never sells it, that is the whole idea of the target maturity system. They will not have, they will not trade, they will not seek capital gains. That is, they will simply follow the index, and in the index itself, unless there is some kind of problem with the credit rating or something else, they will not change the bond. So they will buy and hold. Whether the fund manager buys and holds, or whether the fund manager actively trades the bond or not, whatever it is, SEBI rules state the NAV of the debt fund should always track the market value of the bonds in the portfolio. So when I hold a 40-year gilt bond, the fluctuations in the price will be wild, because everybody will be speculating next RBI meeting they will increase the interest rates. No, it will, after 2 quarters only they will do it. There will be lot of speculation. So when such speculation happens, what happens is, people don't want to buy a 40-year-old bond when the interest rates are just about to increase. If the interest rates increase, the next 40-year-old bond will have a higher rate. Then they have to sell the existing bond at a loss. So nobody wants to buy it. So the volatility will be high because of the speculation. The volatility, the bond managers will call it as beta. They will, because they are looking at it relative to another bond or risk-free index. The volatility in the price will be very high, and in case of events like interest rate changes, or because of COVID crisis, or some other kind of market crash where there is a sudden depletion of players in the market, or depletion of money in the market, there will be a sudden gap in the demand and supply. Suddenly the bonds will be there, nobody will be able to buy them, or there will be too many buyers and the bonds are not available in enough numbers. Then the risk of the volatility in the NAV, I should say, or the risk of capital gain or capital loss will be very severe in the case of 10 years or whatever it is. So now, assuming that the Bharat Bond ETF fund manager has bought a 10-year bond, assuming there's only one bond in the portfolio, what they'll do is they'll just buy and hold it. So after 1 year, it will that 10-year bond will be 9 years. Then it will become 8 years. 1 more year, it will be 8 years. And so gradually, the average maturity of the portfolio will keep falling down. But as the average maturity falls down, since the bond is going to the bond tenure, the remaining bond tenure has become lower, the fluctuations in the volatility will become lower. So the NAV volatility will start gradually fall down as the average maturity decreases. So this is a very nice way to handle duration risk or interest rate risk, because just 6 months before 6 months before the maturity date, the target maturity date, the entire bond portfolio will be basically holding cash. So you have a very nice way of holding a longer term bond in a mutual fund, which has got tax benefits compared to directly buying the bond. You have a very nice way of reducing the interest rate risk, and the bond manager will save you the trouble of shifting to a liquid fund or a money market fund or whatever it is before the goal period. And it will be basically, when it comes the last few days of the portfolio, when it will be cash, and you can effectively cash. The fund manager would have before that it will be in cash equivalents, small money market bonds in the last 6 months, and then as the target maturity is going to end, it will be basically cash. They'll just disperse it and wind up the fund. So it's a very simple, nice way, elegant way of handling interest rate risk. But you must be careful. This is the modified duration of the fund. The modified duration is a slightly different and complex way of measuring the interest rate risk. Again, it will start falling down. It will not always fall down, as you can see, but it will gradually fall down. Those fluctuations should not matter too much. What matters is that the returns. For a NFO investor, the returns will be more or less similar to what was indicated, the indicated yield at the NFO period. Probably it was close to 7.5%, something like that, if they don't sell in the middle. But for people who enter in this middle, if they, for example, if you want to do an SIP in a target maturity fund and so on, your returns will be very complex. They will, because the yield will depend on it will be marked to the market. So your yield will fluctuate depending on demand and supply. So for people who enter in the middle, the yield will be very, very different. So you cannot make guesses on what your yield will be if you buy and sell in the middle. But if you buy in the NFO period and decide to hold it until maturity, then there will be a close matching. Although there can be events because the portfolio can change. If assuming all that doesn't happen, then if it's a smooth ride, then it will be a reasonable match with the indicated yield at the NFO period. Now, should you invest in these funds? Depends on the portfolio. If they are gilt funds, then you can safely invest. If your target maturity matches the need, if the target maturity of the fund is 6 years, and your son needs or daughter needs money for college after 6 years, you can consider investing this as one of the funds in the portfolio. There's not a big problem. Of course, you need other funds for managing the portfolio in the 6 years and so on, but this can be one component. But unnecessarily don't buy it if you have a need 15 years away, and if you are going to buy a 6-year target maturity, there's no need for it. I mean, there's no real benefit in doing that. So, and also like I said, the portfolio matters. I would prefer a pure gilt portfolio. If I have a corporate bond and the PSU bond and state development loan kind of portfolio, there can be issues and there can be credit rating changes, and the portfolio may change, and there will not be credit events, but the yield can deviate from what was presented initially at the NFO period. So the disadvantage with the target maturity fund is, if you enter at the NFO period, then okay. But if you don't enter at the NFO period, or you can enter immediately after that 1 year, 2 years later and so on, it's safe, but your returns, you cannot have you don't know what your return will be. It's not a bad thing, but still you must be aware of that in mind. So if you have any questions, post them below.